clock strikes 8 a.m. in London. Markets across Europe are waking up, traders are glued to their screens, and in just a few minutes, billions of dollars will move across Forex, stocks, and commodities. This is the London Open, the most profitable trading session in the world. But why is it so powerful? Why do seasoned traders consider it the heartbeat of global markets? And most importantly, how can you take advantage of it? Stay with me until the end of this video, because I'm going to break down exactly why the London Open is the best time to trade, what strategies work, and how you can avoid the traps that blow up most accounts. 1. The global importance of London. When we talk about the financial world, there is one city that stands above the rest: London. For centuries, London has been the heartbeat of global trade, banking, and investment. But in modern times, it has evolved into something even more powerful: the largest foreign exchange hub in the world. Nearly 40% of all daily Forex transactions flow through London. Think about that for a second. Out of trillions of dollars exchanged every single day in the Forex market, almost half of that passes through desks in London banks, hedge funds, and trading firms. That level of dominance is not just impressive, it's game-changing for traders like you and me. Why is London so important? To understand this, we need to look at geography and timing. London sits in a perfect time zone. By the time European traders begin their day, the Asian markets like Tokyo, Hong Kong, and Singapore are still open. Meanwhile, in just a few hours, New York will join the action. This creates an incredible overlap where global financial centers connect. No other city in the world sits in such a strategic sweet spot. When London opens, it's not just Europe trading, it's the entire world sensing together. Now, let's put this into perspective. During the Asian session, markets are usually quieter. Liquidity is lower, spreads can be wider, and the big moves are often limited. Traders in Asia are important, of course, but the sheer volume of institutional money isn't the same as what happens when Europe wakes up. The moment London banks and financial institutions start placing orders, the market transforms. Suddenly, volume increases, spreads tighten, and volatility kicks in. This is why the London Open is famous for explosive moves. Institutions don't just dip their toes into the market, they move billions. And wherever big money goes, the market follows. London is also unique because it's not just about Forex. It is the epicenter of global finance. Commodities like gold, silver, and oil are heavily traded here. The London Bullion Market Association, for example, sets the daily benchmark price for gold. That's right. When the world looks at the price of gold, it's London that decides the standard. For traders, this means that the London session is the best time to catch major moves in precious metals. The same goes for equities and bonds. London sets the tone for Europe and often for the rest of the world. Another critical reason London matters so much is institutional participation. We're not just talking about retail traders clicking buy and sell on MetaTrader. We're talking about major hedge funds, pension funds, investment banks, and multinational corporations executing huge positions. These entities move the market in ways that individuals simply cannot. When they shift money, trends are formed, liquidity zones are tested, and volatility spikes. If you understand this, you stop seeing the market as random and start seeing it as the result of large players making deliberate moves. And let's not forget the influence of news and economic releases. Many key reports, such as inflation numbers, employment data, and central bank announcements, are released during or just before the London session. This adds another layer of movement. For example, a Bank of England interest rate decision or a major European central bank update can cause GBP, EUR, and even USD pairs to surge or collapse within minutes. If you are prepared, these moments can create incredible profit opportunities. If you're not prepared, they can wipe you out. So, when we say that London is the financial capital of the world, it's not just a slogan, it's reality. Every single day, institutional traders, central banks, corporations, and retail traders collide in this session. The scale, the volume, and the timing make London unique. It is the session that connects Asia with America, the session where liquidity is highest, and the session where the most profitable opportunities often appear. If you are serious about trading, you must understand that the London session is not optional. It is essential. It is where trends begin, where volatility reveals itself, and where the direction of the day is often decided. To ignore London is to ignore the core of global trading. To embrace it, however, is to place yourself at the center of the world's biggest financial playground. 2. The London Open Explosion. If you've ever looked at a chart right around 8 a.m. London time, you've probably seen it. The market suddenly wakes up. Candles that were slow and quiet during the Asian session suddenly stretch long. Prices spike up or down, liquidity pours in, and traders around the globe rush to catch the move. This is what we call the London Open Explosion, the surge of volatility and momentum that hits the markets the moment London financial institutions start trading. So why does this explosion happen? The answer lies in one word: volume. The Asian session is important, but it often lacks the sheer weight of institutional orders. London, on the other hand, is home to some of the biggest banks and hedge funds in the world. When they step into the market at the same time each morning, they don't trade small positions. They place massive institutional orders worth billions. And because these orders hit the market at once, we see huge bursts of volatility. This explosion isn't random, it's structured. If you watch carefully, you'll notice that many pairs consolidate during the Asian session. Prices move sideways, ranges are tight, and the market feels stuck. That's because big money is waiting. Institutions use the quieter Asian hours to set the stage, building liquidity, trapping retail traders in small moves, and preparing for the real push at the London Open. When 8 a.m. arrives, the trap is sprung. Suddenly, price breaks out of that range, sweeping liquidity and creating the sharp moves we see on the chart. Now here's where many traders get caught: the fake move. The first few minutes of London Open often produce what looks like a strong breakout. The market might spike up through Asian highs or crash down through Asian lows. Retail traders jump in, thinking they've caught the trend of the day. But often, this first move is a false breakout designed to trap them. Institutions push price in one direction just to gather liquidity, then reverse hard in the opposite direction. The result: retail accounts get wiped, and big money controls the real move. This is why patience is so important during the London Open. Smart traders don't just chase the first candle they see. They wait for confirmation. Does the market respect the breakout, or is it just a liquidity grab? By waiting for the pullback and watching how price reacts, you avoid becoming part of the crowd that loses money every morning. Another thing to note is the speed of movement. During London Open, prices can move in ways that are shocking compared to other times of day. A pair like GBP-JPY can run 50-100 pips in minutes. Gold can spike 10 or a 15 almost instantly. That kind of volatility is both an opportunity and a danger. If you're on the right side of the move, you can make in 1 hour what you might normally make in an entire day. But if you're wrong, or if your stop loss is too tight, you can lose everything just as quickly. The London Open explosion is also a psychological battlefield. Traders feel the pressure. They know this is the most profitable time of day, and that creates FOMO, the fear of missing out. Many traders enter without a plan, chasing moves and hoping to grab quick profits. But the market punishes impulsiveness. The London session rewards traders who come prepared, who have mapped out Asian highs and lows, who know their risk, and who understand that not every spike is the real move. Another key factor driving this explosion is news releases. Important European data often drops right around the London Open. Think about UK inflation numbers, German business confidence reports, or even central bank updates. These events can supercharge the volatility, turning an already explosive open into complete chaos. If you're aware of the calendar, you can either trade the news volatility or step aside until the dust settles. To sum it up, the London Open explosion is not random noise. It's the direct result of institutions entering the market with size, liquidity being hunted, and global traders positioning themselves for the day ahead. For retail traders, it is both the most profitable and the most dangerous time to trade. If you learn how to recognize the traps, wait for confirmation, and respect the volatility, you can turn this daily explosion into a goldmine. But if you treat it like a casino, it will destroy your account. 3. The best pairs to trade. One of the biggest mistakes new traders make during the London Open is trying to trade every single pair on their watch list. The truth is, not all pairs move with the same energy, volatility, or liquidity when London banks open their doors. If you want to maximize profits and minimize unnecessary risks, you need to focus on the pairs that consistently deliver clean moves during this session. Let's break them down. GBP USD, the King of London. The first pair we must mention is GBP USD, also known as the Chable. This pair has deep historical roots. It got its name because price quotes were once sent across the Atlantic via undersea cable between London and New York. Today, it remains the flagship currency of the London session. Why is GBP USD so powerful at this time? The answer is simple. It represents the world's two most influential financial centers, London and New York. When London opens, UK economic data, Bank of England policies, and European market flows all impact GBP. Later in the day, US data takes over. This means cable often sets the tone for the day right at London Open. Traders love it because spreads are tight, liquidity is massive, and moves are strong enough to deliver profits, but still structured enough to analyze. If you only picked one pair to specialize in for the London session, GBP USD would be the safest choice. EUR USD, the world's favorite pair. Next is EUR USD, the most traded currency pair in the world. While EUR USD tends to move steadily throughout the day, during the London Open it often produces sharp breakouts and strong momentum moves. The reason is straightforward. Europe is awake. Germany, France, Italy, and the broader Eurozone drive huge amounts of financial activity. Economic releases like German business confidence or Eurozone inflation often land around London hours, sending EUR USD into explosive moves. Combine that with the influence of the US dollar, and you get a pair that's liquid, technical, and predictable for skilled traders. If you're looking for consistency, EUR USD is your friend. It doesn't always have the same wild volatility as GBP JPY, but it offers smoother price action that many traders prefer. GBP JPY the beast. If GBP USD is the king, then GBP JPY is the beast. This pair has earned its nickname because of its insane volatility. GBP JPY can move 100 to 200 pips in a single London session, creating massive opportunities, but also massive risks. Why is it so explosive? First, you have the British pound, which is naturally volatile during London hours. Then you combine it with the Japanese yen, a safe haven currency that often reacts strongly to global risk sentiment. When institutions move money in or out of yen positions while London traders push GBP, the result is fireworks on the chart. This pair is not for beginners, but if you have the discipline, patience, and ability to manage risk, GBP JPY can deliver life-changing trades. Gold XAUSD, the London metal. London is not just about currencies, it is also the global hub for gold trading. The London Bullion Market Association sets the global benchmark for gold prices, and massive institutional flows pass through London every single day. During the London session, gold often mirrors the volatility of GBP and EUR pairs but adds its own flavor. Traders rush into gold as a hedge against uncertainty, and with Europe's constant political and economic shifts, those moves can be sharp and profitable. Gold is particularly powerful during the London-New York overlap, when institutional investors position themselves for the US session. But even right at London Open, gold frequently delivers clean breakouts from overnight ranges, giving traders a chance to ride momentum. Why not every pair works? While these four GPUSD, EURUSD, GBP JPY, and gold are the best choices, you'll notice something important. They are all highly liquid, heavily traded, and news-driven during London hours. On the other hand, pairs like AUD NZD, Shade JPY, or exotic pairs don't move with the same structure during this session. Liquidity is thinner, spreads are wider, and institutional interest is limited. That makes them far less reliable for traders seeking consistency. Final thoughts: if you want to succeed at the London Open, simplify your strategy. Stop trying to trade everything and focus on the pairs that matter. Specialize in 2 or 3, learn their personalities, and track how they behave day after day. Remember, the London Open isn't about chasing random moves. It's about aligning yourself with the pairs that institutions care about the most. And if you do that, you'll start trading smarter, not harder. 4. Strategies for the London Open. The London Open is exciting, but it's also one of the most dangerous times to trade if you don't have a plan. Every day at 8 a.m. London time, billions of dollars flood into the markets, creating sharp moves, fakeouts, and liquidity grabs. If you show up without a strategy, the market will punish you. But if you prepare with proven methods, you can take advantage of the chaos. Let's break down the 3 most effective strategies for mastering the London session. 1. The breakout strategy. One of the simplest but most powerful methods is the Asian session breakout strategy. During the Asian hours, the market usually consolidates. Price moves in a tight range, often just 20 to 40 pips for major pairs like GBP USD or UARD USD. This range is important because it creates liquidity zones, stop losses above the highs and below the lows. Here's how the strategy works. Mark the high and low of the Asian session. When London opens, watch for price to break out of that range. If the breakout is strong and supported by volume, you enter in the direction of the move. The key here is confirmation. Don't jump in just because the first candle spikes. Wait for a retest of the breakout level or a continuation pattern that shows institutions are committed to the move. This strategy works best on pairs like GBP USD and GBP JPY, which often explode right out of the Asian range. 2. The fakeout trap strategy. Now, let's talk about one of the most common tricks institutions use during London Open, the fakeout. This is when the market appears to break out of the Asian range, only to reverse hard in the opposite direction. Why does this happen? Institutions know retail traders love the breakout strategy. They push price just far enough to trigger retail entries and hit stop orders, then reverse and take the real move for themselves. Here's how to avoid the trap. Don't chase the first breakout candle. Wait and see if the breakout holds or if price quickly reverses. If it's a fakeout, the reversal often leads to a much larger and cleaner move than the initial spike. By training yourself to recognize these traps, you can stop being the prey and start trading alongside the hunters. 3. The reversal setup. Another powerful London Open approach is the liquidity sweep reversal. Before pushing price in the real direction, institutions often grab liquidity. They'll drive price up to sweep Asian highs or push it down to take Asian lows. Once those stops are cleared, they reverse the market and begin the true trend of the session. To trade this setup, watch for sharp moves that grab liquidity beyond the Asian range. Look for signs of exhaustion, long wicks, slowing momentum, or volume drying up. Enter on the reversal with a tight stop and aim for a large risk to reward ratio. This strategy is especially effective on volatile pairs like GBP JPY and gold, where liquidity hunts are common. Risk management. The real edge. Strategies alone won't save you without proper risk management. The London Open is fast, and one wrong trade can wipe out your account if you're careless. Always keep lot sizes within your risk tolerance. Use stop losses based on structure, not emotions. Aim for at least a 1s and 2 risk to reward ratio. The truth is, surviving London Open is about protecting your account just as much as it's about making money. Final thoughts. The London Open rewards discipline, not greed. Whether you're trading breakouts, fakeouts, or reversals, the key is patience. Let the market show its hand before you commit. Most retail traders lose money at this time of day because they're chasing the first move. The traders who win are the ones who wait, who understand liquidity, and who use risk management as their weapon. If you can master these strategies, the London Open will stop being chaotic and start being your most profitable trading window. 5. Risk management, the secret weapon. When most traders think about the London Open, they imagine fast profits, big breakouts, and the thrill of volatility. And while that's true, there's another side to the story: danger. The same volatility that creates opportunities can also wipe you out in seconds. That's why the real secret weapon in trading the London session is risk management. It's not glamorous. It's not flashy. but it's the difference between long-term success and blowing your account. Why risk management matters? Let's start with the basics. Trading is not about winning every trade. Even the best traders in the world only win 50–60% of the time. The reason they're profitable is because they manage their risk better than everyone else. They don't let one bad trade destroy them. During the London Open, this principle becomes even more important. Volatility is high, spreads are tight, and moves happen fast. If you're over-leveraged or careless with stops, a single 5-minute candle can hit your account like a sledgehammer. Without risk management, you're gambling, not trading. Lot size. The foundation of control, the first step to proper risk management, is using the right lot size. Too many traders risk half their account on a single trade, hoping to get rich quick. That's a recipe for disaster. Instead, smart traders risk 2% of their account per trade. For example, if you have a 100,000 account, that means risking no more than 10–20 per trade. That may sound small, but remember, consistency compounds. 10 small, disciplined wins are far more powerful than one reckless gamble. By controlling your lot size, you give yourself room to survive the inevitable losses that come with trading. Stop loss, your lifeline. The second pillar of risk management is the stop loss. Think of it as your lifeline. Without it, the market can drag you deep underwater. During the London Open, markets move fast. If you trade without a stop, you're one spike away from a margin call. But here's the catch. Your stop loss shouldn't be random. It should be placed based on market structure. Look for swing highs, swing lows, or liquidity zones. Your stop should sit where the trade idea is proven wrong, not just where you feel comfortable. This way, every stop is logical, not emotional. Risk to reward ratio. The trader's edge. The third key is your risk to reward ratio. This is the formula that separates professionals from amateurs. A smart trader doesn't risk $50 to make a 20 here, they risk $50 to make a 100 or 150. That's a 1/2 or 1/3 ratio. Here's why this is powerful. Even if you only win 40% of your trades, you can still be profitable because your winners are larger than your losers. During the London Open, where volatility can create big moves, aiming for high risk to reward setups is essential. Emotions and discipline. Risk management isn't just about numbers. It's about emotions. The London Open is intense. Candles are flying, news is dropping, and social media is buzzing with traders shouting about their profits. It's easy to get caught up in FOMO and overtrade. Discipline means sticking to your plan. If your risk per trade is 1%, don't suddenly risk 10% because you feel confident. If your stop is hit, don't move it wider, hoping the market will turn. These are emotional mistakes that drain accounts. The best traders accept losses as part of the game. They don't fear them and they don't chase them. They trust their edge, knowing that over time, proper risk management will protect their capital and grow it steadily. The truth about consistency. Here's a hard truth: most traders lose not because they don't know strategies, but because they ignore risk management. They want fast results, big profits, and overnight success. But trading doesn't work like that. The London session can make you rich in opportunities, but it will also test your discipline. If you respect risk, you'll still be in the game tomorrow, next week, and next year. If you don't, the market will take you out, guaranteed. Final thoughts: risk management may not sound exciting, but it is the true secret weapon of profitable trading. Lot size, stop loss placement, and risk to reward ratios are your shield against the chaos of the London Open. Combine these with emotional discipline, and you'll stop trading like a gambler and start trading like a professional. Remember this: profits are temporary, but survival is permanent. Protect your account first, and the profits will follow. 6. The London-New York overlap. If the London Open is the most explosive start to the trading day, then the London-New York overlap is the grand finale. This is the period when two of the world's largest financial centers are active at the same time: London and New York. It happens daily between 1 p.m. and 4 p.m. London time, 8 a.m. to 11 a.m. in New York. For traders, this overlap is the most liquid, volatile, and opportunity-rich window in the entire 24-hour Forex cycle. Why the overlap matters. To understand the importance of this overlap, Think about the sheer scale of trading activity. London already accounts for around 40% of global Forex transactions. New York contributes another 20–25%. When both sessions are live, more than 2/3 of global Forex volume is flowing through the market simultaneously. This flood of liquidity means two things. Tighter spreads, brokers and banks are competing heavily for orders, so transaction costs drop. Massive volatility, institutions are executing big positions, reacting to news, and adjusting portfolios. The overlap isn't just busy, it's when the real market direction for the day often takes shape. Economic news catalyst. One of the biggest reasons the overlap is so explosive is economic news. The US releases critical data right at 8:30 a.m. New York time, just as London is still open. These include non-farm payrolls, NFP US, inflation data, CPI, GDP reports, Federal Reserve statements. At the same time, European news can still be influencing the market. When these forces collide, you get some of the biggest moves of the week. It's not unusual to see pairs like EUR/USD or GBP/USD run 100 pips during this window, especially on high-impact news days. Which pairs perform best during the overlap? Certain pairs become the main stage for action. EUR/USD with both the Eurozone and US active, this pair delivers massive, clean moves. GBP/USD, London and New York flows collide, creating sharp breakouts or deep retracements. Gold XAU/USD, New York traders bring heavy volume to the gold market, amplifying moves already started in London. Indices like S&P 500 or Dow Jones for traders who also trade equities. This is when Wall Street opens and sets direction. If you're looking for volatility, these markets rarely disappoint. Trading strategies in the overlap. There are a few powerful ways to approach this session. News breakout strategy. On days with high-impact US news, wait for the release. If price breaks key support or resistance with volume, follow the momentum. Reversal strategy. Sometimes, London pushes the market one way in the morning, only for New York to reverse it completely. If you spot exhaustion signs, you can catch these dramatic reversals. Continuation strategy. If London sets a strong trend and New York confirms it with further volume, this overlap can give you the cleanest continuation setups of the day. Dangers of the overlap, of course. Where there's opportunity, there's also risk. The overlap is notorious for whipsaws, sharp moves up and down before the real direction emerges. Traders who chase the first spike often get stopped out. The trick is patience. Wait for the dust to settle after major news releases, then enter with confirmation. Why professionals love it. Institutional traders thrive on liquidity, and the overlap gives them exactly that. Big funds can move hundreds of millions without causing erratic slippage. Retail traders, on the other hand, get the benefit of clean trends and tight spreads. This is the one time of day when professionals and retail traders align in the same playground. Final thoughts. The London-New York overlap is the most important 3 hours in global trading. It's where the day's biggest opportunities are born, where institutions reveal their true direction, and where traders with discipline can make serious profits. If you've been struggling to find consistency, focus your energy here. Instead of trading 24/7, master this overlap window. With preparation, patience, and proper risk management, it can become the single most profitable part of your trading career.